Yo, 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 what's going on out there? I am CPA Strength. I am the strongest licensed CPA in the state of Florida. And what do you do, CPA Strength? I teach the world accounting, the basics, building block by building block by building block. This is part of my classic series. This is the classics. This happens to be number 61. Say, hey bro, if you're at number 61, that means you must have had 60 other ones. Where are those 60 other ones? Good question. The other 60 videos are right over here in this card right here. It's the best playlist in the world for accounting. Best playlist, period. It's like a genie bottle, make all your dreams come true. What are we going to talk about in Accounting for Beginners, the classic series? I risk getting trolled. What does everybody think about the haircut? I can see the dislikes now, but whatever. You gotta live life sometimes, right? And will that make the cut? Who knows? Get back to this. What is 61, bro? 61's about depreciation. It's all about depreciation. It's all about depreciation. I wanted to put in, I know we've talked a bunch about depreciation before. We've done about a ton of depreciation journal entries. We've just done accumulated depreciation. You think, well, this could have came first, buddy. But it's like this. It's like, what came first, the chicken or the egg? And kind of how I started. I kind of got the big picture, and then I started picking things up as it went around the big picture. Look at that. Yeah, you didn't think I was gonna do that, huh? What's up with that there? Woo! Arr! Boy, your boy's a dog, right? Arr, arr. Anywho, yeah, we're doing depreciation now. We're gonna go deep into depreciation. We're gonna go deep into it. You know, I don't like to say what we're gonna do the next couple of videos. I just like you to come along with it. So anyways, I've been wanting to give a special shout out to sleep, number one. Shout out to sleep. Number two, actually no, number one shout out, I want to give it to my art history teacher. And when I went to community college in Eugene, Oregon, Lane County Community College in probably 2000, right after Y2K, and it was art history class, and Betsy was like, oh, it's such a crazy world out there. You know, let's just turn the lights down and just forget about all the problems out there and just look at our little art history slides. And man, I tell you, I like to do that. So shout out to Betsy, because I used to just like get lost in all these art histories and whatnot. So that's kind of how I feel now. You know, it's a crazy world out there. Let's just forget about that crazy world and let's go to the land of accounting, where nothing's changed for, you know, 500 years. So it's like our own little mythical world. Think about what else hasn't been unchanged for 500 years. Like nothing, right? You know what I'm saying? What's good 500 years ago, it's good now. What do you still use? Not much. Alright, so we're doing depreciation. Basically, we're doing depreciation. That's the gist of it. And the next couple of videos are going to be about some depreciation action Jackson. The definition of depreciation out of the book. The periodic recording of the costs of fixed assets as an expense. See, the periodic recording. So the annual, let's say the annual recording of the costs of fixed assets as an expense. So the costs, we're going to annually record the costs of what? Of a fixed asset. This, in our case, the fixed asset's going to be this pizza truck. Alright, yeah, we're selling pizza, man. We're slinging pizza off this truck. So that's our fixed asset. And we're going to periodically record the costs annually as an expense, as a depreciation expense. So yeah, let the cat out of the bag there. That we're gonna be slinging, because I love pizza. I'm fat. Yeah, you all know that. Obvious. That's pretty obvious. I love pizza, and I decided, hey, you know, on the thumbnails I'm always eating Yeah, because I'm fat. And what do I want? What's my fictional business? I could have any business in the world. I'm selling pizza. That seems like the best, because pizza's the best. So if you sell it, that means you probably already have it. So I could just sell it to myself. Hello? Sometimes you gotta think, right? So yeah, we're selling pizza. So basically, the whole thing with depreciation is, right, you buy something, like we bought this truck for $5,000. We're gonna keep it for 5 years, and we want to record the costs periodically. We don't want to record the cost all at once. Like when we buy it, we don't want to just say, oh, car expense, you know, a car, you know, we don't want to put truck expense. We don't want to do that. Because you just use it for that 1 year, and you're going to use it for 5 years. So you want to expense it over the time you use it. Now we've gone over that before, so we're going to keep going on. Now you might know all that. You know all that before. So there's going to be three factors, and I got this out of the book as well too. There's 3 factors in computing depreciation expense. So there's 3 factors. So let's see. So let's say you're just pulling up in the new whip. Oh, and these are 20s, by the way. These are 20s, not 10s. They are clean though, but they are 20s. I know you're thinking they're 10s and you keep them clean. They're not 20s. No, they are 20s. Okay, these are 20s. So you just pulled up in your new whip, your new pizza whip. And what are the 3 factors in computing depreciation expense? Number 1, assets initial cost. What was the initial cost when you first bought it? Our first initial cost of the pizza truck, $5,000. $5,000. Second factor. So that's easy, right? That's not brain surgery. What's the initial cost? Number 2. What's the second factor? Assets expected useful life. How are we going to find that out? How to pick how many years asset will last? You can go to the IRS. They have charts. You can ask your tax preparer. You might want to talk about, you know, what method are we depreciating? Are we doing a straight line or double declining balance? What method are we doing? How many years are you depreciating it, so I can get my books correct? So it kind of just depends on the tax preparer and what he's putting on the tax return. You might just do a section 179 and expense the whole thing at once, but that's for something else. But I wouldn't worry about too much on, you know, just look it up. Most things are going to be 5 to 7 years. It's not going to be the end of the world if something's supposed to be depreciated in 5 years and you depreciate it in 7 years, or vice versa. You know, it's all so you're gonna expense it in different times, but it's all gonna expense out in 5 or 7 years. Not the end of the world. Just do the best you can, and everything's gonna be fine. I know from doing enough tax returns, and I just plug it into I just look at my tax system how I figure out depreciation. I say, oh, I have a vehicle, and it'll say, oh, vehicles 5 years. I say, okay, 5 years. Boom. That's how I figure out how many years the depreciation is. Third factor in computing depreciation expense: the asset's estimated residual value. I guess that's for up to you. If you're trying to figure it out yourself, the business owner, you say, oh, after 5 years, after the useful life, we're gonna get rid of it. We're gonna scrap it. Are we gonna get any money out of it? How much money are we gonna get? How much money do we expect to get? I'm gonna tell you in the next couple examples, we're gonna have estimated residual value of 0. That's how much I'm going to expect. It's another little thing. When I was going in school, and every single example I always had a residual value. And don't worry, we'll do a couple examples with residual values. And the example that I'm going to do with the pizza truck, no residual value, because when I first got to my job and I guess my real job, well, when I became a CPA, and then I started doing some tax returns and some books and stuff, and I noticed, oh, like all these assets, nobody has residual value. And I don't know, the lady taught me a lot without any degree or anything, but she knew a ton, and she taught me the most out of anybody probably. The least education I worked with taught me the most, so let that be a lesson now. But she was like, no, I mean, no, they're not, once they're done with the asset, they're done with it. Like, you know what I'm saying? I got my printer. Once I'm done with that, man, I'm freaking, oh, I mean, it's been good to me, but I'm gonna slam it like Office Space or something. But, so in our example, we're not gonna have, and that just gets you thinking with the real world. Like, you know, the books are one thing, you gotta learn the basics, and in the real world, you're off the porch, you know. What else is on here? What date the asset is purchased, that matters also. Like if you buy it, say if you buy it in November, this pizza truck in November, well, I only had it for 2 months of the year. Do I get to depreciate it for the whole year? I mean, no, you would depreciate it for, you know, 2 out of the 12 months, so 2/12, you know, 1/6. So that's just another thing that's going to be in some examples in some future videos. The next 2 videos we're going to do is, so once you figure out that, now you can decide. Now this is the fun part for me. Like, this is fun for me because I just kind of figured this out through my own business after 10 years. Like, oh, this depreciation method is going to save me money, and oh, that's what it all means. And it was like, oh, light bulb, eureka. But so we're gonna take this pizza truck that cost us $5,000. That's gonna last 5 years and have 0 residual value. And in the next video, we're gonna depreciate it with what method? We're gonna use the straight line method. In the video after that, we're gonna depreciate this pizza truck that cost us $5,000. We're gonna use in 5 years. Yes, very useful life in 5 years. And then we're going to do what method? The double declining balance method. So we're going to do the 2 different methods. Same specifications or whatever. Same initial cost, useful life, residual value for both the straight line and the double declining balance. And eventually, all of the depreciation will be, all of the $5,000 will be used up in depreciation. It's just going to happen at different times. The straight line is going to happen, you know, a certain amount every year. The double declining balance is going to be a higher amount at first and a lower amount at first. So then you got to start thinking here, why? And this is like the fun of taxes and accounting for me, and because I get to like save people money, real life people, real money, and who don't like them chippers, boy. Why would you? Let's see. Why would you not want more expense this year? Why would you not want to take more depreciation this year? More depreciation this year, less depreciation next year. So maybe I don't have to pay as much tax this year because I'm not making as much money, because a lot of new startup businesses don't make a lot of money. Like, I am a startup business 2 years in, so I'm not making a lot of money, a lot of profit, so I don't have to pay a lot of tax now. So I don't need that extra depreciation expense now, so I want it slow. I don't want to take all my depreciation expense now, because even without it, I don't really have to pay any taxes because I'm not really making any money. So I'm saving that depreciation for maybe 3, 4, 5 years down the road when I am making more money, hopefully, bless up, when I'm making more money, and now I have to owe taxes, but now I have more depreciation expense, and I have more expenses, so I pay less taxes. Was that a mouthful? OMG, I love doing this. Woo! Man, let's just stay positive, stay grinding, have fun, be blessed. Let's love this life. You only get one. Let's enjoy it. Come on, let's go. I hope to see you in the next one. Hope to see you in 62. Deuces.